Okay, let's dive right into this. If you've spent your entire career building up a nest egg in a 401k or an IRA, you're eventually going to face a pretty massive mental shift. You have to transition from saving your wealth to, well, actually spending it. And one of the absolute most debated strategies for making that shift is rolling those funds over into a fixed indexed annuity, or an FIA. Is it a safe haven? Is it a complex trap? We're going to break down the objective realities of 401k to annuity rollovers today. We're stripping away all the sales pitches to just look at the pure mechanics.
Because, let's be honest, this is the question that keeps so many people up at night. What if a market crash happens the exact year you retire? Think about it. When you're in your 30s, our 20% market drop, that's just a blip. You've got decades to recover. But when you're finally stepping away from your paycheck, that exact same drop can literally devastate your retirement income permanently. It's this phenomenon called sequence of returns risk, and it triggers a very real fear of just outliving your money.
So here is our roadmap for this explainer to help you navigate this. 1. The retirement income dilemma. 2. Decoding indexed annuities. 3. Understanding caps and floors. 4. Executing a tax-free rollover. And 5. Weighing risks and rewards.
Let's start with Section 1, the retirement income dilemma, the wealth to income shift. Now, what's really interesting about this breakdown is just how different these two approaches are. Shifting from wealth accumulation to income generation requires a completely different mindset. Look at the stark contrast. With a traditional 401k, you are absorbing all of the market risk. Sure, you have incredible growth potential, but your withdrawal strategy is entirely on your shoulders, and honestly, it's unpredictable. An annuity, on the other hand, is fundamentally different. It's actually not an investment in the traditional sense. It's a contract with an insurance company. You're basically trading in some of that limitless market growth for contractual guarantees, downside protection, and lifetime income. You are literally transferring the risk from your own shoulders directly to the insurance company.
Moving on to Section 2, decoding indexed annuities. What is the contract?
So, a fixed indexed annuity, or FIA, is a specific type of deferred annuity. It's designed to give you growth potential based on the returns of a market index, while simultaneously providing an absolute safety net against negative returns. I really cannot emphasize this enough. It is an insurance contract. It is absolutely not a direct stock market investment. You are buying a contractual guarantee.
As you can see, your money's growth is tied to the performance of a well-known index like the S&P 500, for example. But here's the kicker. Because you don't actually own the underlying stocks, your performance doesn't include dividends. You're simply using the index as a sort of measuring stick to determine exactly how much interest the insurance company is going to credit to your account.
All right, Section 3, understanding caps and floors, the safety net and ceiling.
Look, insurance companies don't just offer downside protection out of the goodness of their hearts, right? They afford it by limiting your upside during bull markets, and they do this through 3 main levers. First up is the participation rate. This is the percentage of the index's growth you actually get credited. So, if the market goes up 10% and your participation rate is 70%, you get 7%. Make sense? Second is the cap. This is a hard, strict upper limit on the interest you can earn in any given term. And third is a spread, or asset fee, which is basically a percentage subtracted right off the top of the index gains.
And this brilliantly illustrates that exact trade-off in action. If the market gains 10%, your FIA captures a portion of that, limited by the caps and participation rates we just went over. But look right in the middle there, a market drop of 15%. This is exactly where the FIA shines. Thanks to the 0% floor, your credited interest for that year is simply 0. Your account value doesn't go up, sure, but it doesn't lose a single penny of principal due to the market tanking. 0 becomes your absolute hero.
Section 4. Executing a tax-free rollover, moving your money safely.
So once you've decided those mechanics actually align with your personal goals, precision is absolutely crucial. The cleanest, easiest way to fund your annuity is through a direct rollover. Once you've consulted a professional and picked your contract, you simply sign some authorization paperwork. That's pretty much it on your end. The financial institution holding your 401k wires the funds directly over to the insurance company issuing the annuity. Because the money never actually touches your hands, it's a completely tax-free transfer. Your tax-deferred status remains perfectly intact. No stress.
But you need to beware the indirect rollover. If you ask your 401k provider to send the check to you personally, well, that triggers an automatic 20% IRS withholding right off the bat. Plus, an incredibly strict 60-day clock starts ticking immediately. You have exactly 60 days to deposit the full amount, and yes, that includes the 20% you didn't even receive, into the new annuity just to avoid severe taxes and early withdrawal penalties. You definitely don't want to mess with that. The crucial takeaway here is stick to direct institution-to-institution transfers. It saves you from a massive, unnecessary headache.
Finally, Section 5. Weighing risks and rewards. Is it right for you?
Let's actually look at the hard data for a second. There was a fascinating study from the Wharton School, authored by researchers including Professor David F. Babel, and they analyzed actual real-world fixed indexed annuity contracts. They found that, historically speaking, the returns have been highly competitive with alternative portfolios of stocks and bonds. But even more importantly, their design successfully limited the downside returns associated with declining markets, exactly as promised. Professor Babel notes that annuitizing a portion of your assets can provide desirable consumption levels and a much more worry-free retirement.
Now, we have to balance the scales here to be completely objective. The pros are incredibly powerful. You get guaranteed lifetime income that you literally cannot outlive, continued tax deferral, and absolute principal protection from market crashes. But the cons? They are equally significant. FIAs are highly illiquid. If you need your money back early, usually within the first 6 to 10 years, you are going to face incredibly steep surrender charges from the insurer, plus a potential 10% IRS penalty if you happen to be under 59.5. And of course, for sure, your upside potential in a roaring bull market will always be capped.
And because of those limitations, very few financial professionals would ever recommend rolling your entire 401k into an annuity. Actually, scratch that. Doing the whole thing is usually a terrible idea. The smartest approach is almost always the partial rollover strategy. Here's how it works. You calculate your essential monthly retirement expenses. Then you subtract your guaranteed fixed income, things like Social Security or maybe a pension. Whatever gap is left over, that is the exact amount you roll into the annuity to build an unbreakable income floor. You leave the rest of your 401k invested in the market for liquidity, growth, and fighting inflation. Which leaves us with one final, absolutely critical thought to ponder today. Have you actually calculated your essential retirement income gap? Before you sign a single contract, before you move a single penny, you need to know your numbers. A fixed indexed annuity isn't a magic wand, and it is definitely not a total portfolio replacement. But as we've seen in this explainer today, when it's used precisely to fill an income gap, it is an incredibly powerful tool for transferring risk away from your retirement. So take the time, run your numbers, consult with a fiduciary, and see if building an income floor makes sense for your future. Thanks for hanging out with me for this explainer, and keep learning.